Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm joined today by John Addis, editor-in-chief of InvestSMART.
Hi, Tony.
Thanks for coming in, John.
Thank you.
And today we're going to have a bit of a chat about China. What's happening there?
Well, who knows? I think that's one of the mysteries about China, is that the statistics are unreliable. We all know that the country grew at a rate of 10% a year for 15 years, and that rate has now come down to 6 or 7%. According to Chinese statistics.
Yeah.
There's a lot of concern around China, I think, and I think that sort of understates the potential that there is for Australia in the growth of the Chinese middle class and what that means for our investments.
I mean, it's just enormous what's happening there, and
the numbers are just so hard to grasp.
Yeah.
You know, they are incredible to grasp. There are universities in China which have been built for 1.5 million students. There are factories with 400,000 people in them, working in them. And one of the reasons why Apple subcontracted its iPhone manufacturing to Foxconn, which is a Taiwanese company built in Shenzhen, is because when they opened the factory, they needed 9,000 engineers. And in the US, they said that to get 9,000 engineers would take us about 18 months. And in China, they managed it in 9 days. So it's very hard to grasp what the size of this country is and the level of economic development that has occurred there over the past 30 or 40 years. And I think the big message for investors is that while we get caught up in the short-term headlines over, say, the collapse in the Chinese stock exchange, or concerns over Chinese corruption or political instability, the fact is that countries tend not to deindustrialize. And China is one country that has, in effect, deindustrialized when Mao turned up. And because of that, I think there's less chance of China actually going backwards from here. So although there might be short-term problems and there's lots of bad debt in that system, it's almost inevitable in the way that the economy has grown that there will be malinvestment. I don't think that this is going to destroy the economy from where it is now. And in fact, in the long term, it's going to be far bigger and far more important to Australia than it is even now.
I mean, there's been a lot of commentary over time, is Chinese growth, slowing to an extent where Australia should be worried? I mean, having been there, it's just the size of industrialisation is just massive everywhere you go.
That's right, and we shouldn't ignore the law of large numbers that applies to a country like China, where it's not really rational to worry about a growth rate declining from 10% to 6% or even 5%, especially when it's 1.2 million people, 1.3, 1.4 million people. That's still 5% of 1.4 million people earning 5% more a year is a lot more demand. And I think there's lots of evidence now that China is making that transition away from an investment-led economy to a consumption-led economy. And we can see that showing up in the stock prices of A2 Milk and Bellamy's and companies like that. And I think in future we're going to see more of it. So I'm not a complete China bull. I think there are clearly problems there. But I think that the way these problems are reported gives investors the idea that the whole place is going to blow up. And there probably will be some kind of pullback, but we are not going to go back to where the country was 30 years ago.
Yeah.
And that's a significant point the investors, I think, are forgetting.
Yeah. And you wrote a great piece about this last weekend, which was, very extensive. Tim Treadgold also wrote a piece the other day about what's happening with the coal price. And that's been surging on the back of Chinese demand again.
Yeah, that's right. And that's another thing to worry about when you think of the carbon emissions of a highly developed country of 1.2 billion people. But I'm not going to worry about that. There's not much I can do about it, unfortunately. But I think generally that this is a pretty good story long term.
Yeah, I mean, a lot of that coal's being used in, the industrialisation process. So, and that's not going to stop suddenly. So, in terms of our own mining exports, that means there's going to be...
Absolutely, and it's not just coal, it's also iron ore. So even though there's There's a lot of concern in the sector because the capex cliff, as they call it, we've fallen over that. But all of that investment that's occurred over the past 8-9 years is now resulting in record levels of production. So almost every month, more iron ore gets exported from Port Hedland now than any time ever in the past. So that's something that's underplayed in the media. You know, we are exporting more in terms of volume, but the lower prices mean that it doesn't show up in the accounts, in the national accounts, as it used to 5 years ago.
Yeah, very much so, and it can only have positive effects for the Australian economy.
Absolutely, absolutely.
All right, John, well, thanks very much for having that chat with me on China.
Pleasure. Thank you very much, Tony.
And I look forward to seeing you again next time.
You will. Thank you.
Thanks.